Hey there! Welcome to Smart Stock Moves. In today's video, we'll be discussing a topic that's on the minds of many investors. Can the stock market go up during a recession? We'll explore this question and provide some valuable insights on how to protect your portfolio in times of economic downturn. Make sure to stick around until the end to have all the information that you need. What is a recession and how does it affect the economy? Before we dive into the relationship between the stock market and recessions, let's take a step back and define what we mean by a recession. A recession is a period of economic downturn. It's typically marked by a decline in GDP, also known as gross domestic product, for 2 or more consecutive quarters. Recessions can be caused by a variety of factors, such as a slowdown in global economic activity or a financial crisis. During a recession, the overall performance of the economy suffers, and this can have a variety of consequences for individuals, businesses, and the stock market. For example, companies may experience declining profits and revenues, which can lead to layoffs and reduced investment. Consumers may also reduce their spending, which can further impact businesses and the economy as a whole. Now that we have a better understanding of what a recession is and how it can affect the economy, let's get back to the main question of this video. Can the stock market go up during a recession? The short answer is yes, it is possible for the stock market to go up during a recession. In fact, the stock market has often shown resilience in the face of economic downturns. And it is not uncommon for it to experience gains even during a recession. There are several reasons why the stock market can go up during a recession. One reason is that the stock market is a forward-looking mechanism, which means that it tends to anticipate future economic conditions rather than reacting to current ones. This means that the stock market may go up during a recession if investors believe that the economy will improve in the future. Another reason is that the stock market is influenced by a variety of factors beyond the state of the economy. For example, the stock market may be impacted by global events, corporate earnings, and changes in interest rates, among other things. These factors can offset the negative impact of a recession on the stock market, leading to gains even during an economic downturn. How do recessions affect the stock market? While it is possible for the stock market to go up during a recession, it is also important to note that recessions can have a significant impact on the stock market. In general, recessions tend to be accompanied by a decline in the stock market, as investors become more risk-averse and companies struggle with declining profits and revenues. During a recession, investors may be more likely to sell their stocks in order to preserve capital, which can lead to a decrease in stock prices. At the same time, companies may cut back on their operations, leading to a reduction in earnings and potentially causing their stock prices to decline. It's also worth noting that the severity of the recession can have an impact on the stock market. In general, deeper and longer recessions tend to be accompanied by larger declines in the stock market, while milder and shorter recessions may have a smaller impact. Before we continue, if you find this video helpful, make sure to give it a thumbs up and leave a comment below. How can investors protect themselves during a recession? You're an investor, it's natural to be concerned about the potential impacts of a recession on your portfolio. While it's impossible to completely eliminate risk in the stock market, there are several steps you can take to protect your investments during a recession. 1. Diversify your portfolio. One of the most effective ways to mitigate risk in your portfolio is to diversify your investments. This means not putting all your eggs in one basket, but rather spreading your investments across different asset classes, industries, and geographies. This can help reduce the impact of any one particular investment declining in value. 2. Consider defensive stocks. During a recession, it may be wise to consider investing in defensive stocks, which are stocks that tend to hold up better during economic downturns. These stocks may include companies in industries such as healthcare, utilities, and consumer staples, which tend to be less sensitive to economic cycles. 3. Stay the course. It's important to remember that investing is a long-term game, and it's normal for the stock market to experience ups and downs along the way. While it may be tempting to sell off your stocks during a recession, it's important to stay the course and ride out the storm. History has shown that the stock market has always recovered from previous recessions, and it's likely to do so again. 4. Have an emergency fund. It's always a good idea to have an emergency fund in place to help you weather unexpected financial setbacks, including a recession. This fund should be easily accessible and contain enough money to cover your living expenses for several months. In conclusion, it is possible for the stock market to go up during a recession, but it's also important to be aware of the potential impacts of a recession on the stock market. By diversifying your portfolio, considering defensive stocks, staying the course, and having an emergency fund, you can help protect your investments during a recession. Thank you for watching this video on the relationship between the stock market and recessions. Don't forget to hit the subscribe button to stay up to date with all the latest from Smart Stock Moves.